Hello Sector Watchers, welcome to the show. This is the 83rd episode of Sector Spotlight for Tuesday the 8th of June, recording it on Monday the 7th. My name is Julius de Kempenaer and I'm hosting the show again today, presenting to you from Amsterdam in the Netherlands. Today I want to obviously do a look back to last week's rotations for asset classes and sectors. And hopefully we can do, well, I'm sure we can do a little bit better than last week, because last week was a very full show with the seasonality and all the monthly charts. So we're going to do a little bit more extensive look back on last week's rotations, try to put that into perspective, see what's going on in sectors and asset classes. And then in the second half of the show, or after the look back, I want to spend some time, and that's probably going to take up the remainder of the show, going over the long-short baskets that we're maintaining here. It's been a while since we spent some time with that. Last time was in an RRG blog somewhere in April, so it's about time we're going to do a review. So we're going to take a look at all the names that we're currently monitoring on both the long and the short side, and then see if we can find some new additions, or maybe we need to remove some stocks. But that will be after we had a proper look at what happened last week and see what it tells us about what's coming. Starting at the top of the investment pyramid with the asset classes, asset class rotation. I've loaded up two RRGs for you. One is on the left is the daily RRG showing last week's rotation, or last 5 trading days. That was ending on June the 4th, that was Friday. And then on the right hand side I've immediately put the weekly RRG, so we can go from daily to weekly to see what the impact of last week's rotation has been or will be in the weekly picture. If we go quickly over the performances, then we see that it was another very good week for the real estate sector. V&Q gained 3.3%. And also the commodity, both commodity ETFs that we're tracking here, DJP and GSG, both up 2.1%. So very strong for commodities, in line with the longer term picture. Now, the benchmark, VBINX, up 0.5%, 50 basis points. And that means that usually both the main components, so stocks and bonds, have been very close to each other. And again, that happened this week. So stocks, ITOT, the total stock market index, up 70 basis points, and government bonds up 20 basis points. That results in a 0.5 gain for the index, the balanced index. Now, and you can also see that these here, so that's GOV, that's all the fixed income stuff, was very close to the benchmark. ITOT also very close to the benchmark. Not a lot of difference, so everything very much in line with the index, except real estate and commodities. If we move over to the right hand side where we have the weekly RRG, then we can see that the bigger trends are still present. Real estate, very good week, is still very good on the weekly chart, but it's losing momentum, so it's going through some sort of a pause. The question will be whether this is strong enough to drag V&Q to the right on the weekly as well, and basically continue its current period of strength. On the commodities, we do see some difference. Well, we do see some impact, because here on the daily we had some, if you remember what we showed over the last few weeks here, you saw that these daily tails for commodities were very far away. They went from leading to weakening at very long tails, and they started to curl up, and you see that is now picking up here on that daily chart, and you see that is translating into the weekly tails, especially for GSG, which was still in weakening and curling back up. And DJP actually that's sort of a jackknife. That's a really fast turnaround. Nevertheless, positive. And if you would rank this universe, then GSG here would be the strongest, then DJP, and then V&Q. You go from right to left. So the higher on the RS ratio scale, the stronger the trend. And then the next one is ITOT, and also what you can learn from this is that ITOT, so stocks, is still much, much stronger than government bonds. Nevertheless, there is plenty of room for the total stock market index to go further down here inside the weakening quadrant, and for GOVD and LQD to go higher inside the improving quadrant. And it is very hard to tell whether this is a temporary move and we will see stocks curling back up and going to leading and GOVD rolling over and back to lagging, or are we witnessing the start of a real change in trend here? I don't know, it's way too early to tell, but I do think we need to monitor it, because the tail for ITOT is now definitely heading lower on the RS ratio scale for quite some time. You see it here. So here we started to roll over, that's February, and we sort of continuously, very slowly in stealth mode, continued to lose relative strength, while government bonds have been doing the opposite. That makes it a tough call, but just based on the facts and on the readings here, stocks are still the preferred asset class. If we quickly take a look at a few of the price charts that belong to this universe and to these RRGs, then here we have the total stock market index. As you can see, still well inside the boundaries of that rising channel, but it's now for the third week having trouble pushing above its previous high. So that's a loss of momentum in itself. And you can see something similar, albeit very, very early yet, happening in the RRG, in the relative strength line. What we can see here in the RRG lines is that the pace of this trend, so the momentum, the rate of change of that trend, is stable. It's not there. It's just going up, which is good, but it's not accelerating. And here at the end, it looks as if it's now starting to roll over, which means that it's starting to decelerate. It's hardly visible on the price chart itself, but the indicator tells you that there is a loss of momentum towards the end here. Again, this high reading of RS ratio puts it still very confidently above 100 and to the right side of bonds, but it is something that I'm keeping an eye on, because if you heard the last couple of episodes of Sector Spotlight, you may have noticed that I still am cautious for what's ahead of us. I'm not sure that the rally that we're in is going to continue straight higher up from here without any hesitation or consolidation. And that brings me to the chart of the S&P 500, and I started maintaining a daily chart of the S&P 500 just to give you some a little bit more granular feedback on what's happening in the stock market. And what you see here is that the high was set, and that is, where was that? May 7, and also May 10, so that's a Friday and a Monday. But on that Monday, you saw that roll over, and on the rest of the week it declined. So those 2 days, the high was 422.82. And then we started rolling over, and we had a couple of very bad days, a couple of very bad weeks, and now we started recovering. But you can see that in the last few weeks, it never managed to actually push really higher. Yeah, we did that. We did that on Friday, the 4th of June. 422.92, 422.82. Now, if I see those peaks being formed at almost identical levels, these are the examples that I want to tell people who say that technical analysis doesn't work and that the market has no memory and support and resistance is not feasible. And then I asked them, so how can you explain that the market literally stops within tenths of points on the index? And then usually it gets very silent. So I think that we can conclude that 422.80. I'll round it off. 423 is a pretty important resistance level for the S&P 500. As you can see, we're still inside that trend channel. There's no problem there. But there's room to 405 at least. So that's 15 points for the S&P 500. Not massive, but still some downside. And if we get out of that channel, then obviously the downside opens up a bit more. Now, a few weeks ago, I had a negative divergence between price and RSI pointed out here. And this was a bright red line, and there was a red line connecting these highs as well. I've now faded that line because I don't think that it is valid anymore. That negative divergence basically did its job. It led, or it preceded this drop here and the pause, and it's now picking up again. And when I see this, and I see that that negative divergence sort of faded away, I wanted to take a look at how that looks on the weekly chart. And what you see here is a new negative divergence building up, but now on the weekly chart of the S&P 500. And obviously, when it happens on the weekly chart, has much more impact than on the daily. And I think this is actually a pretty serious divergence building up here that we should take into account. So, story for the S&P 500, long-term trend still up, tactical, short-term, near-term, risk to the downside, and I want to wait and see how that's going to play out. And we'll have a deeper look at sectors, because we're going to dive into the S&P 500 and see how that translates into the sector rotation. And here are the RRGs for the S&P 500 sectors. On the left-hand side, the daily version. As you can see, market is already closed when I'm recording it, so I'm going to put this back to last Friday. Then we have an exact week, last 5 trading days up to Friday. If we do a quick sort on performance, then you can see there was a very good week, extremely good week actually, for energy and real estate. And also technology had a good week, followed by financials and staples, 1.5, 1.2. Utilities 0.9, and then the S&P gained 0.8%, and everything else is below the S&P 500. So that's materials, industrials, communication services, healthcare, and consumer discretionary. Now, if we go over the tails, then there's a few that catch the eye. The first one, obviously, and the most obvious one is real estate. That's a really nice tail, gaining on both axes. Nice RRG heading between 0 and 90 degrees, so that's doing absolutely fantastic. Real estate sector really doing very well at the moment. If we look at energy, then we see that that's curling up. That's a very good sign, because it was in weakening and we're going back up. I'm going to put that into the weekly chart later on, but that's actually energy together with real estate doing really well. Now, technology is going through a couple of good weeks actually. Let me max that out here, maybe a little bit bigger. You can see that over the last few weeks, technology actually picked up, rotated back up, so went over a couple of good weeks. And now you can see that despite the fact that we're coming really close to crossing over into the leading quadrant, it's still possible, but we're already starting to lose on the relative strength scale, on the RS momentum scale. That's usually not a very good sign. So that is a warning signal. What is doing pretty good here, well, is communication services. It's staying very close to the benchmark. Look at the shortness of that tail. That's almost static if you compare that to a few of the others, like to real estate, energy, etc. So communication services, let's see, probably with utilities, even staples is longer. So utilities and communication services, very short tails. Now communication services on the right hand side. So that means that was actually holding up and doing pretty well and very stable in that week on a relative basis. Healthcare, we discussed healthcare last week. based on seasonality. Well, that is not following the seasonal pattern in the first week of the month, so we'll have to keep an eye on it. There is still, well, I'm not going to say plenty of room, but there is room for healthcare to actually pick up and do its seasonality justice in the remaining weeks of the month of June. But for now, it's quite disappointing, I have to say. And then here we have discretionary, which is sort of in line with technology, but further to the left, which it means that it is weaker and already leveling off and potentially rolling over. Now, if we go into the update, so it is already to today, you see that that process has continued. So real estate continued further up. Communication services continue to move to the right, energy continue to move higher, and tech, well, moved to the right, but still lost momentum, and discretionary sort of horizontal. Now, how does that translate into the weekly charts? And let me put that on alphabetical order on both sides, it's easier. And let's pick a few that are really important. And I think I said first the real estate. Real estate, so on the left-hand side, powering into leading, and on the right-hand side, stable on the momentum scale and moving higher on the RS ratio scale. That's good. That's strong. So it makes real estate a really strong sector at the moment. I think there's the danger, because some of these are unclear, but some things are really clear. And what's really clear on the weekly is the weakness for technology and for consumer discretionary. Now let me zoom that out, bring that up here. On discretionary, it's very, very visible. It started to, a couple, 3-4 weeks ago. And we now see the first signs on technology that it went through that hiccup and now starts bending over back to the left. And if we compare that to the tail on discretionary, it looks as if discretionary is just leading the way for technology. Went up a couple of weeks and then started to pull to the left and then starts accelerating to the left. And that is something that could be very well the same scenario for technology. Now, these are two major sectors, and when they underperform, it'll be very hard for the market to actually put in an absolute performance. So this would fit the narrative of a pause, more corrective mode for the S&P 500, led by technology and discretionary. And the reason I'm saying that is because the market is not giving us utilities and staples and healthcare on the weekly is still good. So these are more the defensive sectors together with energy. And really only energy is starting to pick up. So that's really the only defensive sector that is in a all-out relative uptrend. For utility, staples and healthcare, that's not the case yet. So I'm sort of hesitating on that offensive defensive rotation. We definitely had some defensive rotation over the last few weeks, but I think that the clue to this market is held by technology and discretionary. Both are inside the lagging quadrant, both start to lose momentum again, and I think that's where our focus should be. If we get the technology and discretionary right, and right now I think that they're underperforming, that's probably going to have a major impact on what's happening in the S&P 500. So for now, please stay cautious with tech and discretionary. The last time I discussed the long long-short baskets that I am monitoring here on Sector Spotlight and in the blog was actually in the RRG blog on May 6th. And at that time I added IP, International Paper, to the list as a long position. And we ended that article with these baskets. And what I do is I keep those I save those as an RRG, and from time to time keep an eye on what's happening with the rotations on, this is the long side that I'm showing you right now, but we'll see that I also have a short version for the short side as well. And then I have a chart list which holds the charts for all positions. And what I want to do is really quickly go over the current positions and then see if we need to remove or add new positions. So I'm going to do it alphabetically. Easiest, yes. So that is the MSCI Canada. So that's the position that we took because we thought that, or I thought that Canada was going to outperform the S&P 500. If we look at the chart, then we see that it's actually a very nice chart. You can't get much better than that. And relative strength versus the S&P 500 is doing what I was expecting it to do. It's actually continuing to outperform. So as far as I'm concerned, EWC still deserves a position on the list. Then EXR is inside leading, losing a little bit of momentum, not dramatically. And if we look at the chart, then you see that that turnaround is now materializing and the uptrend is still there and intact, no problem at all. If we look at IP, that's the latest edition, nice RRG heading. And if you look at the chart, then you see that it is holding up above its former resistance line and we're breaking above resistance in relative strength. So no problem maintaining that position for now. And then IVE, which is part of the growth value growth value rotation. At the moment, IVE has been losing somewhat of its relative momentum. But if you look at the chart, then we're about to break higher. This is the one that may not be up for taking profits because we're actually, and I've calculated it, this trade is up 13%. The difference between the performance of value and growth is 13%. So maybe it's time to take some profits for the time being because it's on the right hand side and because we're in that rising channel. I'm gonna keep it on the list as a position. The same for the consumer discretionary small caps, which was the play against XLY, which is in the short basket. If we look at that chart, then we see that it is trying to break higher. We had another good day today, and it's bouncing against its support line. So small cap consumer discretionary expected to continue to outperform large cap consumer discretionary. And now we have Wells Fargo, which is dropping into the weakening quadrant, but it's very high on the RS ratio scale. We can see that that trend is still there and it's bottoming out. We're going to some sort of a pause, but actually that turnaround in relative strength is still doing very well. And then finally we have waste management, which is inside the leading quadrant and still doing its thing. It's now consolidating a little bit. I want to give this the benefit of the doubt and give it the time to actually break higher before we're going to review it. So on the long side, no problem. All these positions are still pretty much doing what I was expecting them to do. Let's quickly move to the short side. Short basket here. That looks pretty positive, but then again, the whole market has been doing pretty strongly lately, so that is to be expected. If we go over the individual positions, and again, let's do it on a alphabetical order. AWK, this is the rally, but it's still way below its support levels, and this chart has plenty of room to roll over and come down again. So this is heavy. Upside in relative strength is heavy. for me, enough reason to keep it as a short position in our basket. PG, already rolling over, insight improving, had a couple of good weeks. Procter & Gamble, here it is. And you see that we're struggling with overhead resistance, but this relative strength line is sending negative signals, and we're already starting to roll over. So I'm going to expect PG to actually continue to roll over and move back to the lagging quadrant. Here's the counterpart of growth, of value. Here's growth, counterpart of value. You see that it is picking up a little bit, but there's not a lot of strength behind it. And if we're going to put that onto a chart, you can see that it is not reaching its high here. That downtrend is still there. So the combination, I'm going to give it the benefit of the doubt, and we're going to remain short growth, long value. Costco, insight improving, but already rolling over, starting to lose momentum again. So if you look at the chart, that is struggling with its overhead resistance coming from that previous peak out of late 2020. We're struggling with relative strength, and I'm going to expect this to roll over and continue back to lagging and add to our position or add to our portfolio from the short side. RRG, ETR, lost a little bit of momentum, is now coming closely, dangerously close to crossing over into leading. When we look at the chart here, then you can see that it is against the upper boundary of its trading range, and it's pushing against a falling trend line in relative strength, and that still makes it a short for me. That still makes it, there's plenty of room to the downside, both in relative and in price. MTD, just crossing over into the leading quadrant. Maybe we were too early for this, but you can see that this is the rally. This is causing that move up, and we're now putting in a new lower high. We're doing the same on the relative strength basis. So I'm gonna stick with this position for now, because I'm gonna expect that relative strength will continue to decline and move lower, which will eventually pull that price lower. And then we have consumer discretionary, which is paired with the PSCD position on the other side. And that very clearly is the weak sector, and we discussed it when we were doing the overview. And this is what really worries me in terms of price development for consumer discretionary and relative development, because it just pushed to a new lower relative value, and it's dragging the RRG lines down. Now we're running out of time, so I'm going to wrap it up here, and I'm going to show you my new additions to the long-short basket. On the long side, we're going to add CRM, and on the short side, it's going to be SWKS. Two technology stocks at a weak sector, but I'm going to write it up in a new article explaining exactly why these positions are added to the long-short list. Be on the lookout for that article sometime tomorrow, which is today for you when you're watching, so hopefully it's been published when you watch this. I gotta wrap it up. This was Sector Spotlight for today. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope you enjoyed the show, and I hope to see you back next week at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.